And my co-host on the Best of Investing.
Hey, Laurent.
Hey guys, how are you?
Good. Hey, can you hear me okay? Because I'm a little bit far from the speaker.
Yeah, I can hear you great. Can you hear me?
Oh, yeah, perfect. Yeah, we've got a mic right up to the speaker, so we can hear you like you're here. But sometimes I have to speak up because I don't want you saying what? What'd you say?
All right.
So bad radio. Huh?
So if you guys are ready, we are going to go ahead and start. And Laurent, just as we did before, I'll do the intro, and then I will introduce you as from Group RMC to discuss purchasing real estate in the Midwest. Is that okay if I introduce you that way?
Sure.
Okay.
Hey, Laurent, I'm going to admit that one of my associates was going to be here to do this show, so I'm coming in kind of last minute. I didn't get a chance to look over any of your stuff, so Edward gave me a little bit of a really quickie description of what you do. But, we'll ask you questions and we'll have some fun.
Yeah.
Sure, no worries. I mean, I'm sure you know your stuff pretty well. So.
Oh, yeah. No, we do everything on the fly here.
It's kind of fun. But you guys sitting around a bar having drinks without the drinks talking business. Okay, here we go. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is general trivia. Our special guest on the phone right now is Laurent Massa of Group RMC to discuss purchasing real estate in the Midwest. And Laurent, you're actually from Canada, aren't you?
Yeah, I was born and raised in Montreal in Quebec, Canada.
Okay. And your company, RMC, now you've been purchasing a lot of real estate in the United States, mostly in the Midwest, right?
Yeah, that's right. We've been purchasing real estate in the Midwest since, I think our first deal there was 2011. But our history in real estate goes back to the 1980s with my dad, who started buying up property in Texas during the savings and loans crisis.
So, Laurent, what's your favorite state right now, and what type of real estate are you buying? Are you buying single-family residences, or are you doing multifamily or commercial?
Favorite state, that's a good question. I have a few. I like Ohio. We have some stuff in Minnesota. I would say one of the best-kept secrets in the country is actually Kansas City. If any of you guys have been down there or plan on to, I think you'll be very surprised at how much of a booming place that is. And as far as the type of real estate we do, we have a very narrow criteria for real estate. We do large, institutionally maintained office buildings and office parks.
Okay, so no residential, it's just strictly office.
No residential. I know multifamily is sort of the hot trend right now in real estate, but as you get to know us, we kind of stay away from crowds, and we do strictly office.
So the area of real estate, Laurent, that you're playing in, so to speak, the area of the pool, and it kind of sounds like it's the deep end of the pool with that type of commercial real estate. Is this an area that individual investors can participate in, or are you buying in a volume that would really kind of keep the small players out?
Well, we have. I mean, our partners, our group of investors, our partners that are not really clients. They're really our partners. They're mostly families that we've known for a long time, and now family offices. And we've opened up a new channel in the United States and in Canada, whereby investment advisors can invest their clients' money into a fund, which invests in the deals alongside us, like the other LPs. So there's a bit of everything to answer your question. We have some bigger investors that come in deal by deal, and they'll put in a good chunk of change. Then we have some sort of middle of the road people who've been with us since the beginning, and then we have the regular retail, I guess you could say, investor that comes in through a fund. So yeah, to answer your question, a little bit of everything.
And I assume they all have to be accredited investors?
Well, to come in directly, yeah, you have to be an accredited investor.
Okay. And can you share any kind of rate of return you guys have earned for your clients?
Well, it depends on the deal, but we aim to pay out distributions quarterly of about 7% cash on cash. That's our aim.
Okay.
Is that an annualized return?
Yes, annualized, paid out quarterly.
And I'm assuming you don't deal in California at all.
No, we don't. Not because we don't like California, but just because things tend to be quite expensive on the coast. That's probably why we're mostly in the Midwest, because it's sort of I guess you could say, kind of an unloved place.
Yeah.
But that's our specialty.
What concerns you the most about what's what we're all projecting and predicting as to what's going to happen in the economy in the next year or two?
That's a great question. So one of our something that kind of sets us apart from other real estate institutions is that we're permanent capital. And so what that means is we're not bound by a 5-year or 7-year or 10-year time horizon. We look at real estate the way it should be looked at, which is a permanent asset. So a risk that comes with that is when you're a permanent owner, it's not if there's going to be a recession, it's when is there going to be a recession. So how do you avoid that? Well, the two biggest killers in real estate are time and money.
Yeah.
We're obliged to go into a deal very well capitalized because we know that things are going to happen. Tenants might default. If we're well capitalized, we're in a very good position to not only keep tenants in our building, but also maybe have a bit more of a competitive rent set and steal tenants from other buildings.
Well, Laurent, does that mean that you're putting down a large down payment and taking on very little debt?
No, it doesn't. No, it doesn't mean that. It means that we have a lot of cash reserves going into the deal that we can use to make tenant improvements or to make sure our building stays competitive when other buildings are kind of struggling to.
So, how much leverage when you purchase a building do you usually have?
I would say depending on the deal, between 60 and 70% leveraged.
Okay, so you're putting roughly 30% down and leveraging 70%. Okay.
Exactly.
All right. And your competitive edge is the fact that you're well capitalized, because your deals, you do fairly large deals, don't you?
We do. We do. I would say anywhere between 500,000 to 3 million square feet.
Just a bit.
Just a bit. Yeah.
Are any of the structures you hold this real estate in, or do you do any REITs?
No, we don't do any. We don't do any REITs. We're not. We're deal by deal. So we're just basically a group of families and investors who come in and buy at the deal, and that's it. Every deal is its own LPGP structure. So we're not exactly structured like a REIT.
Okay, and Laurent, stay with us. We're going to cut to our first commercial break here. First trivia question is: in which country did Ho Chi Minh come to power? All right, call 888-912-1190. Be the first caller with the correct answer. You're going to win that tanning certificate. Again, the question is, in which country did Ho Chi Minh come to power? Stay with us. You're listening to The Best of Investing. We're going to be right back. All right, that's segment number 1.
Give us some questions we can ask you, Laurent. That
it's funny, he
or did.
Did
we ask all of them already?
Yeah, I'm sorry. I was kind of.
That's right.
They weren't really asked. I guess it's my fault. They were asked sort of in a mishmash way. But I would like to elaborate on what brought us to the Midwest. I'll break it down.
Yes, please.
The loan crisis, the referendum, and the recession.
Yes, that'd be great.
And then I'd like to elaborate on the institutional imperative. So that's I guess your question where you were going with are we a REIT? Anyway.
I'll admit, I know Edward just kind of quickly went over the questions, and then I promptly forgot them, so I was just winging it. So.
No
problem.
The REIT structure I asked really because a lot of mortgage pool funds, and we have several, a lot of fund managers are considering, if they haven't already started the process of converting their Reg D filing to a REIT, because it offers a lot of additional tax advantages, some big ones thanks to the Trump Tax Act, and so that's and I think that's a nationwide phenomenon right now. That certain 506 Reg Ds are going, maybe we should convert to a REIT because you get 4 or 5 unique advantages over a typical Reg D fund.
Interesting.
Indeed. So, do you have those questions? I wasn't sure.
Well,
the institutional
we asked them, except for he's going to bring up why the Midwest specifically.
Okay. Yeah. Why don't we elaborate on the Midwest?
Okay.
And and we could go with. I want to talk about how we're different than in, big institutions.
Got it.
Okay. All right. Here.
And when you say big institutions, Laurent, are you talking about like large REITs, for example?
Yeah, a REIT, a pension fund, private equity groups, institutional investors. I mean, those are generally the people we buy off of. So.
And okay, and then hey, Mark, when it's your turn to get into Pacific Private Money, the August distribution was 8.9%.
Yeah, I didn't see the details behind it, so I'm not really sure if that was a one-off or because sometimes you have.
That's because I thought it was because it's selling the loans.
Yeah, well, there was one. I think it's a combination of loan sales, and there was one
foreclosure.
One foreclosure that we did that they had to recognize the mark to market.
Oh,
so
good.
that's
Okay.
Yeah, so
that's something good to talk about.
Yeah.
Okay. All right, here we go. Welcome back to the Best of Investing. Edward Brown here, along with Mark Honk and our special guest, Laurent Massa. First trivia question was, in which country did Ho Chi Minh come to power?
China, right?
No, and I wish Nam was here.
I knew it was a trick question.
Yeah, Vietnam.
Oh,
See, if Nam was here, he would have known that.
Oh, of course. See, I didn't go to Vietnam.
No, of course not. No.
We weren't old enough back then.
No, that's true. Hey, I want to.
We're old now, though.
I want to make a quick. That's true. I want to make a quick mention here for the Urban Tavern, which is located near Union Square in San Francisco. And now that baseball season is getting towards the end, if you can get a buy one get one day. Boy, let me try this again. Buy one get one game day drink deal. So you get one free if you buy one, if you wear your game day jersey. All right. And all you have to do is just show your game ticket or wear a local sports gear and check them out. Urban Tavern near Union Square. All right, Laurent Massa from RMC Group, who purchases large real estate. And Laurent, you were going to explain what brought you to the Midwest.
Yeah, so it's sort of a three-step process that brought us to the Midwest. The first one was, our family's history in real estate goes back to the savings and loans crisis in the 1980s when, specifically in Dallas, Texas. My dad, Ray, and his partner, Tom, they were buying apartment buildings for $2,500 a door when rents were $500 a month. So, there was something. So Ray turns to Tom and he goes, "We're all the smart people." And Tom kind of looked at him and said, "Just shut up and look at the numbers."
Yeah.
You're the shrewd kind of no-nonsense kind of guy. But the answer really set the tone for what the investment philosophy would be moving forward, and that's to kind of stay away from hot markets and crowds, and those tend to drive up prices beyond the actual, intrinsic value of the asset. So that, as Warren Buffett says, and when you have $70 billion, I'll stop taking advice from Warren Buffett. It's hard to go wrong when you buy a dollar for less than a dollar. So that's and then fast forward to the 90s, we had what's called the Quebec referendum, and that happened in 1994, I believe, and that's when Quebec almost separated from the rest of Canada, sort of like a Brexit, except that didn't go through. It almost did, though, 51-49 in favor to stay. Wow. Anyway, there was a huge exodus of business who moved to Toronto, and that big sucking sound let us find a lot of value in Quebec, in places like Jonquière, Sherbrooke, Drummondville, a bunch of places you probably never heard of.
Yeah.
And then finally, that brought us to 2011, after the recession, when the world kind of really got down on the U.S., particularly in the Midwest, where it's kind of common knowledge that it was a dead place, and sellers were pretty eager to get rid of assets at fire sale prices. So we closed our first property in Fort Wayne, Indiana, 175,000 square feet, far away from Silicon Valley, New York, and San Francisco, and the seller was GE Capital, and we bought the asset for a third of the mortgage it held, and for a quarter of what it was built for 25 years.
Oh my gosh! How much in dollars was that?
How much in dollars was
it?
I can't remember. I'd have to check.
Oh.
I have to go back and check. But
Wow.
I mean, not every deal was that great. But
Yeah.
fast forward to today, and we were over just over 16 million square feet, and just over 2 billion in asset value.
Wow.
Well, so you're of a size where you could be discussed in the same conversation with some big institutional players, but like some of the larger REITs and private equity firms. But how do you differ from those guys?
That's a really good question. It's I would say what sets us apart is from REIT, pension funds, private equity groups, institutional investors. Again, quote Warren Buffett, he calls it the institutional imperative, and it's not really in the inherent advantage of an asset manager to, I guess you could say, risk his career, reputation, or by doing something out of the norm. And institutions, they've always been focused on big markets, right? No manager is going to get fired for buying a 4 cap in New York with little upside. But ironically, the same manager can get in trouble for buying a small market 10 cap with upside because no other manager is doing it. So that's why sellers tend to write off places like the Midwest, because it's kind of an embarrassment on their portfolio, and the manager can say in his next conference call, well, he got rid of the 4 Wayne asset. So, and let me be clear, these managers, they're not dumb. They have big degrees. They went to big universities. It's just that
they're selfish. They want to look at. They're looking after their own.
Their motivation's a bit different than ours.
Yeah,
you could say.
Gotcha.
So you're on the hunt for true value, true upside. And have you moved around the Midwest a little bit over the years?
Yeah, we sure have. So we started, like I said, our first deal was Indiana, and then we bought a lot of stuff in Ohio. So we're the largest suburban landlords in Columbus, Ohio. And then we moved a little south, and now we're the largest suburban landlords in Kansas City. We own a lot of stuff in suburban Chicago, and then more recently, I should say, we bought up a lot of property in Memphis, Tennessee. So we're large landlords there as well.
What kind
of kind of moving out to the southeast.
What kind of cap rates are you buying at?
We usually buy around 8 to 10. 10%.
Really? You're able to get those kind of cap rates?
That's amazing.
10 cap on existing NOIs. It's baseline. I mean, variations on the theme are considered, but 10 cap on existing NOI is usually baseline.
Wow. Very cool.
Anything concern you in the economy looking ahead, notwithstanding the fact that you answered earlier about buying real estate for taking the long view?
Well, I mean, there's always risk when you get in real estate. I guess one of our big risks in real estate is your tenant. Let's say you're buying a condo building. Well, if you're or a condo unit and your tenant leaves, there goes your income. So tenancy risk, we tend to try to I think in most of our portfolios, no tenant has more than 10% of our rent roll. So if one leaves, it doesn't affect your bottom line as much. And in terms of their credit, a tenant in New York is a credit tenant in New York is the same as a credit tenant in Columbus or Kansas City. Their check is just as good.
Yeah.
So the other risk, I guess the knee-jerk one, the biggest one would be liquidity risks. And are these markets liquid, or at least as liquid as New York or San Francisco? And the answer to that is only if there's a promise to sell the asset by a specific date. So we're not bound by a term like most institutions or pension plans who have 5, 7, 10-year horizons. Our legitimate risk comes from overpaying, which is something we'll never do. We, waited years to do the right deal and won't buy it for the sake of buying, and our partners are very comfortable with that.
Yeah, it seems kind of ridiculous to put a specific timeline on when you have to sell an asset, because then your back is against the wall potentially.
Yeah, well, it's just how these institutions are structured. I was mentioning, I was speaking to you last week, and I mentioned that a lot of these institutions charge performance fees, and more importantly, their carry fee, which is 20% of the profits. And so they only realize their carry once they sell. We don't charge a carry. The only way we make our economics is up front. We charge a one-time markup on the share price that we call a co-investment premium, which we take in shares of the deal, not in cash.
Very cool.
And so all that does is lower our basis in the deal, and then that way it's pure co-investment moving forward, in addition to putting in our own capital, of course. But we don't have to sell is the bottom line, because we're not incentivized.
Hey, Laurent, we have to cut to another commercial break, and we're going to have to let you go. But how do people get a hold of you if they have an interest in the Midwest?
Well, they can visit our website, reach out to our IR team. All the information is there, grouprmcusa.com.
All right.
You can take a look at our portfolio, our market approach, all that kind of stuff. And shoot an email to our outreach team, and they'll be happy to respond to you.
Great. Laurent Massa from RMC, thank you so much for joining us on the Best of Investing. We got to cut out now.
Thank you for having me.
All right, we're going to cut to a break. We're going to ask the next trivia question next time. Yeah, we went way over.
Okay.
I'm going to get yoga. All right.
It's all right.
He's a nice guy.
Yeah.
8 to 10 cap. Jeez. And they're only distributing 7%. And they're leveraging it. So you're going, I mean, they should be able to pay a lot more than that.
Wow.
Right?
Mm-hmm.
In my humble opinion. Okay. All right. And the question I have for you is, if I want to take money out of your fund, how long will I normally have to wait? Never.
Depends if there's a run on the fund.
Yeah. That's why we say normally, not
Normal,
guaranteed.
yeah.
Okay. Okay. Oh boy. I got this. I tell you, my broker down in Sunnyvale is just phenomenal.
Really?
Yeah, he's just so good. I'm very blessed to have him.
Oh, good. That's really good.
Yeah, because it's trying to deal with these guys. It's just crazy stuff.
Yeah.
No.
No.
Okay, and I've got just a couple of other just little tidbits.
These articles are really. I just happened to print them out because they were actually interesting, but they're really long, and I haven't had a chance to study them. I kind of rushed down here, but there's plenty to talk about. We'll fill the. What's the for the next three? What were the times again?
Times 7:34, 8:48, and 5:10. So I'll ask the secretary a question next time.
Yeah.
Okay.
Cool.
So I have just a thing on minimum wage, and then something E-Trade cutting the commissions to 0.
Yeah. Okay.
Good. All right, ready?
Yep.
Okay, here we go. 1, 2, 3, go. Welcome back to the Best of Investing. Edward Brown here, along with Mark Hunt. We said they had to say goodbye to Laurent Massa.
We ran a little long that time, so we couldn't do the trivia question.
No,
so
we'll save it. We'll save it for
Yeah.
next time. But so I've got a couple of articles here that I wanted to share. One, first of all, just reading, E-Trade is cutting their commissions to 0.
So how does that work? How are they actually making money? Because didn't Schwab also follow up and announce too
Yes.
that it was cutting commissions to 0?
Yes,
I mean,
and TD Ameritrade. So E-Trade assumes they're going to lose $75 million in revenue. Schwab assumes they're going to lose $100 million in revenue. This is just the second quarter. And TD Ameritrade, $240 million in commissions during the quarter.
So they're willing to lose money on every trade, but make it up in volume.
Yes, that's right. Yeah. No, the goal apparently is to push clients towards managed portfolios. So that they get a little sliver of not necessarily a commission, but like an asset management fee.
It's just amazing how technology across the board is pushing prices down on so many items. And it's funny because, and this is a conversation unto itself, people say, well, there is inflation because gas has gone up and the price of, food items have gone up, eggs, milk, etc. But then you look at how technology has pushed down the price of phones, the price
TVs,
of computers, TVs, the technology in cars today, and the internet is just doing its best, these new tech companies, to disrupt so many different areas of the economy. And in fact, we're going to talk just a little bit later about how tech is disrupting the real estate industry and some of what's happening in real estate, which is much to the chagrin of that 6% earning or thereabouts realtor. So it's it's very interesting stuff.
One other article I wanted to bring up here: the Harvard study used reviews on social media sites like Yelp as a gauge of quality here. It says it found that lower rate. Oh, sorry. Let me back up. We're talking about minimum wage.
Oh.
And how in certain markets, restaurants are going to have to close, or they're choosing to close. And it's not going to be the high-end restaurants. It'll be the lower ones, because the minimum wage, if you're at some hoity-toity restaurant in San Francisco, you're not making minimum wage. You're making more than that anyway.
Mm-hmm.
So what are the ones that are paying their employees minimum wage? It's the lower-end type restaurants. And guess what? Low price. And those are the people who need the jobs the most. So they figured out here, according to their estimation, 5-star restaurants were largely unaffected, while ones with a 3.5-star rating were 14% more likely to fail when the city's minimum pay rate rose 10% above the state's minimum. Because state has a minimum, and sometimes cities go, no, we want you guys to have more.
Right, living wages, as they call them.
Yes, exactly. So, I think there's going to be a big backfire with this idea of increasing the minimum wage.
Well, there's a lot of sides to that issue, and it's hard to argue that people don't deserve to have a minimum level of economic sustenance. But on the other hand, the free market should be allowed to dictate, but it's a hard.
Also, those kind of minimum wage jobs theoretically were for the teenagers, that sort of thing. It wasn't supposed to be for someone to make a living off of. And if suddenly McDonald's starts charging $12 for a hamburger because of minimum wage going up, that's going to affect the people who can even buy McDonald's hamburgers.
America's meat and potatoes. Price is going up.
Taters. Okay, those are just the two little articles I want. Food for thought on that. So, Mark, the only reason I know this is because I'm an investor in your fund, the Pacific Private Money Fund. But holy smokes, we've been telling people, yeah, you're paying a little over 7.5%, yada, yada. This last month, the annualized yield hit almost 9%.
Right. So we distribute the profits that are calculated on an accrual basis. So for those of you who know accounting would understand what a accrual-based accounting means, but it's a truer way of reflecting the actual income and expenses of a business or enterprise. And so our fund, we distribute the income that we calculate every month in full. So our shares are priced at about $1,000 a share, and they go up in value during the month as we do our accounting. And at the end of the month, we account for interest income from disposition of any REO projects. Sometimes when a loan pays off, we collect additional interest. Maybe we collect default interest or some late fees. That gets added to the regular note interest rate that gets calculated during the period. Long story short is that the nature of the loans that we make is that oftentimes we make a little bit more than was originally bargained for, because the borrower maybe didn't keep up his end of the bargain, and therefore he had to pay some default fees or some late charges. Fees, yeah. And so those tend to give you a little boost to income. So we had a couple of things happen during the month of August, and so we had a nice little boost there. And it actually, based on several, we have three. We foreclosed on 3 loans in the last 90 days, and all of those are being remodeled for sale, and some of those are going to be at a substantial profit when we sell them. So I would say in the next 6 months, we are going to have similar periods where when the sale occurs during a certain 30-day period, there's going to be a boosted income. So that serves to kind of boost up what we'll earn on an annualized basis. Now, if you're in the fund, you're going to get a chance to benefit from that. If you're not in the fund, or if you join late, well, you kind of miss out on what might have happened, for example, last month. So it's one of those things that when you're in the fund, you get to enjoy not only our kind of fairly stable and average annualized returns around 7.5% is what our trailing 12 is. Although actually now it's a little bit higher thanks to August. But from time to time, you're going to benefit from those little bonus items.
And I'll make you a side bet, and that is that a lot of existing investors are going to be so happy with that distribution, they're going to say, hey, can I add to my account?
Well, and so when you're an investor in the fund, many of those investors are income investors. They do get those distributions in cash, and they will see a nice little jump in that cash distribution. So you're right. The people that let it roll over, unless if they don't read their statement, they won't realize that, hey,
they'll see it.
You got a bonus, yeah.
All right, we're going to cut to another commercial break. When we come back, I want to explain to people, or want you to explain to people exactly, what your fund is, how you can earn such a high rate of return.
Yeah.
All right, second trivia question. Which instrument is particularly associated with Buddy Rich? 888-912-1190. Be the first caller with the correct answer. You're going to win the tanning certificate. Don't touch that dial. We're going to be right back. All right. That was right on some money. Ready?
Yep.
All right.
It's a long one.
1, 2, 3, go. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money. Second trivia question we asked was, which instrument is particularly associated with Buddy Rich?
Was that drums?
Yes.
Yes.
Very good. Drums. Hey, quick mention also for Mountain Mike's Pizza in San Rafael. Pizza the way it ought to be. I've heard from a lot of people that they have excellent pizza. Check them out on 4th Street in San Rafael. Mountain Mike's Pizza.
Making me hungry.
I know. I gotta go there after the show here. Let's see. So, Mark, before I ask you the email question that came in, explain a little bit what Pacific Private Money does, because producing a return for the month annualized at almost 9% is sounds a little too good to be true.
Sometimes, and I feel for people who haven't listened to our show before, and they're maybe just driving around and hearing us, and we kind of, last segment, jumped right into talking about the fund. It's like, what fund? What are you talking about? So just as a, real quick, at Pacific Private Money, we're an alternative real estate finance provider, which is a fancy term for saying we do private money loans, also known as hard money loans. And really the types of loans we do are generally short term. We're the guys you go to when you are in a rush to buy real estate. Maybe your financing fell through, or your money partner didn't come through, and all of a sudden you got to close by next Friday. And so we're the guys that get that call typically, because we can move very, very quickly. We're a holistic lender. We're smart people who've invested in real estate for over 35 years, and we know how to analyze Bay Area real estate, and that's where most of our lending is done, right here in the Bay Area. So we do real estate loans, mostly purchase loans, fix and flip, even for homeowners who are in contract to buy a home. One of the most popular loan programs we have right now is for homeowners who want to move up or move down or move sideways out of town maybe, and they don't want to sell their home first, but all their equity, all their down payment money is tied up in the equity in their home. So what do? Well, we can lend off that equity and provide you with 100% financing or 100% of the purchase price of the home you want to move into, of the home you want to buy that you've identified. Or maybe you haven't identified a home, but you want to run around and compete with cash buyers by giving your realtor the opportunity to make non-contingent or very low contingent offers. Not having a financing contingency when you make an offer on a house is big. Sellers like that. And so when you have a pre-approval from Pacific Private Money, you can run around and mimic cash when, or your realtor can anyway, when he's making offers for you. So basically, we're fast money, we're easier money, and we're generally exist to help people capture real estate when bank financing is just not an option. And again, bank financing is always better than our financing in terms of price. Bank financing is 4%, right? And we're 9% basically. And so people don't come to us to save money. They come to us to save time. They come to us to create a stress-free opportunity for themselves. They come to us when their credit, not everybody we lend to has hammered credit. We do a lot of loans to 800 FICO score clients, but some of our flippers and contractors and other borrowers, they are in the high 500s to low 600s, and so but that's not why it's not, oh, you make seconds to people with bad credit so they can like bail themselves out of trouble. No, we don't make loans like that at all. That's not the business we're in. We're fast, reliable, transactional financing for home buyers and real estate investors.
Well, two comments I want to make is one, the seller financing contingency. I mean, you can't have that nowadays because if you think about, or excuse me, the financing contingency, because the seller probably wants to buy something and he can't buy that house unless he sells this is his house.
It's right. You're trapped between a rock and a hard place. So yeah, you can't.
Yeah, and one of the things, it's funny you mentioned about how bank financing is always going to be cheaper. Maybe from an interest rate standpoint, but not necessarily on a cash flow standpoint. What I mean by that is many times I've seen situations where someone had a bank loan where they've had it for a number of years and maybe they had a 15-year mortgage, and so a huge part of that is now principal, and they may even have mortgage insurance because of years gone by, and from just strictly how much they have to write a check for every month might be actually more than if they borrowed money from Pacific Private Money.
So all of our loans have interest-only payments. You can borrow a lot more money when you know that you're making an interest-only payment. We regularly make loans $1, $2, $3 million in size, and the ability for the borrower to afford that payment many times is largely based upon the fact that the payments are interest only and don't have a $5,000, $6,000, $7,000 a month principal payment added on to that. So
I know sometimes you have to make a 30-year fully amortized loan under certain circumstances.
But the vast majority of loans we do are interest-only payments. So those are the types of loans we make. And if we're charging roughly 9%, sometimes a little bit less, sometimes a little bit more, I would say our loan rates will range from, on the low end, mid to low 8s, and on the high end, the high 9s, maybe 10%. We do junior liens. Junior liens will usually be 10, maybe 11%. We've done thirds where there's like a low first and maybe HELOC second that's maxed out and they've got tons of equity. Would we do a third? Yeah, we do that regularly, particularly in the Bay Area where we really are comfortable with neighborhood valuations. And so again, we exist, and we're making a short-term loan. We're not betting on a 5 or 10 year market. We're betting on a 12 to 18 month market, generally speaking. So if we're charging rates between 8 and 10%, we were able to pay our investors, our fund investors anyway, about 7.5%. And the majority of our investors are in the fund. And for more information, before we run out of time here, because we've got a couple more minutes, we're going to talk about a few more things here. You want to go to our website, which is pacificprivatemoney.com. That's pacificprivatemoney.com. And we're actually we're improving our website quite a bit. We're adding a lot of new features to it, and if you've been there before and you haven't been there recently, go back. There's a lot more information available for you there. Sometimes the best way to find out and get your questions answered, though, is just to give us a call. We answer our phones live. We're in the office every day. We've got staff that is there waiting for your call to talk about the fund and answer your questions about how the Pacific Private Money Fund, which is a mortgage pool fund, how it works. Just a couple of additional things on our fund. We don't use leverage for the fund, so that 7.5% is a true yield. It's not a levered yield. And I know for some investors, they're concerned about leveraged funds. So it's an unlevered yield. And then the weighted average loan to value of loans in our fund is roughly 60%. So, and that's based on when we made the loan. And since prices in general have been rising since we made many of our loans, we're fairly comfortable in stating that.
And the most important question, have you ever lost money?
So we've never lost principal on any loan we've ever made. We've made 1,600 loans. In fact, we've never lost interest either. We've always made at or near the promised return on all of our notes. So it's been and again we're looking forward to the next cycle, and we're adjusting our lending guidelines as we feel appropriate, and looking forward to that.
All right. When we come back after this break, an email comes in and asks about taking money out of the fund, because I'm sure some people sometimes they need the money. That's right. Okay. So here's our last trivia question: who had a 1980s #1 hit song called centerfold? Call 888-912-1190. Be the first caller with the correct answer. You're going to win that tanning certificate. Who had a 1980s #1 hit with, quote, centerfold? All right, stay with us. You're listening to The Best of Investing. We're going to be right back.
I've got a good answer for that.
Okay. You have a good question or answer? Okay, good. Good.
Dave's here. No, Dave's not here. Dave's not here.
He goes, I'm going into a session, so shut up.
That's what he said, no?
That's what he said to me.
Oh.
He was going into his own session there. I don't use such salty language. Or try not to. Danielle seems to be fitting right in. Got that sense of humor, you know?
Yeah.
All right. As my dad used to say, is you is or is you ain't.
Yep.
You ready?
Yep, I am.
Okay. 1, 2, 3, go. Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Massa, president of Pacific Private Money. Third trivia question. Who had the 1981's #1 hit, Centerfold?
That would be John Fogerty.
No.
No, wait, that was center field.
Yeah.
I remember centerfold, but I can't remember who sang it.
Jay Giles,
that's
yeah.
right. Yeah.
That's good. I like that, though.
You can be centerfold. You could be a centerfold.
That's right. Okay, an email comes in.
Yep.
It says, Mark, if I want to take money out of your fund, how long, assuming you have money in the fund to begin with, how long will I normally have to wait?
So that's a redemption request they're talking
Yes.
about. So when you open up an account in the fund, we do have a requirement that you keep the money in there for at least 1 year. If you do that, there's no charge to take your money back out again. So there's no charge to put your money in, ever. And there's no charge to take your money out if you leave it in for at least a year. And what's funny is in 6.5 years, we've never charged an investor a redemption fee because no one's ever pulled their money out in less than a year. So that's kind of interesting.
Yeah.
Wouldn't have guessed that to happen if you had asked me 6 years ago.
Yeah.
But when we have redemption requests every single month, and we've got over 200 investors and over $50 million in the fund, and it's a fairly liquid fund, meaning that because we make short-term loans are paying off all the time. Some of the loans we make pay off in 4, 5, 6 months. And so, I think today we've got $2 million in the fund. So if someone, called us today and said, I need $50,000 and, how fast can you get it to me? Hate to do this to you. I'm really sorry. And that's you. They usually apologize. And I said, well, do you need it today? I can wire it to you today. If you keep it in the fund till the end of the month, you'll get the full month's earnings. If you take it out mid-month, you sacrifice those odd days of interest since the first, because we only calculate once a month the income. So that's the only downside. It's not that big a downside. And usually when people need the money, you need the money. So now larger loan redemption requests, we've had someone redeem $1 million. One of our larger account holders redeemed and went and bought real estate with it. And we've had $500,000 and $600,000 redemption requests. Those, depending on when they come in and the timing of it, we may have committed to make certain loans. And of course, we can't leave a borrower at the altar and say, sorry, we had a redemption request all of a sudden, we can't fund your loan. We don't do that. So if you've got a loan commitment, we will honor that loan commitment first of all, and then put those requests in the queue. So we can't promise when and how quickly we can pay a redemption request because we never know how much money we're going to have in. We don't know how large your redemption request is going to be. But generally speaking, the easy ones, anything $100,000 or less, generally speaking, because of the liquidity in the fund, the fact that we generally have $500,000 to $1 million at any given time, those are easy. We can make those in a matter of days. Larger requests, we may need several weeks. We may need to wait for a payoff, or we could go to one of our private credit lines. I said the fund is unlevered, and it is unlevered, but we do have private credit line relationships with some of our associates that can lend us money on a short-term basis if needed. But generally we're not going to go out and borrow money to do a redemption. Yeah. It really kind of depends. If it was a hardship situation and one of our clients who'd been in for years, we go out of our way to please our clients,
Yeah.
especially the ones that have entrusted us with their savings. So again, for more information, you can call us, and we spend a good amount of time every day talking to people on the phone about our fund, and we try to be as transparent as possible. We can provide you with all kinds of information, financials, loan portfolio statements, all that stuff. There's no tricks, no magic. We lend money on real estate, and that's all we do with this fund. Every now and again, the fund forecloses and owns the property for a short period of time while we fix it up and sell it. And every time we've done that, it's been at a profit to the fund members. So it's a great alternative investment strategy, and you should consider having a portion of your savings invested in real estate debt. And for more information, go to pacificprivatemoney.com or call us 415-883-2150. Anytime Monday through Friday, we'll take your call and have a great conversation with you.
Very good. Thank you. Thoughts for the day. Be decisive. Right or wrong, make a decision. The road of life is paved with flat squirrels who couldn't make a decision. And life is not the way it's supposed to be. It is the way it is. The way we cope with it is what makes the difference.
I thought it was a box of chocolates.
Life is like a box of chocolates. You never know what you're going to get. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. It's funny. I mean, you actually could do, and you probably have done this, in redemptions in tranches. I mean, someone says they need their $1 million and you have $600,000 to give up. You can do that.
Yeah, I didn't think of that. I guess, I get that probably, it makes the accounting a little bit more challenging.
Sure.
But, hey,
It's like, hey, if I give you,
it's not calculus.
Excuse me.
All right. So Thaler didn't get to me. He owes me statements for investor amounts. So both you and Nom's checks are awaiting Thaler's recording. I thought he was going to get it to me today. I would have brought your check down, but I have to get it to you tomorrow or next week.
No problemo.
Yeah. Oh my goodness. Wow. But it's all good. Yeah.
So there's a possibility. Do you know? I don't know if I should say anything now because it's October 12th. I don't know if you and Lisa are available. It's a Saturday.
That's like next week, right?
Yeah.
Don't know what. I've given up trying to get her to go anywhere.
Okay.
12 and 13. So this Sunday I'm going to something, but I don't have anything on the calendar for next weekend.
All right. Let me. Just sort of put it way back in your mind because I may have something coming up that might be kind of fun to go to. But
Okay.
I have to kind of ask somebody because
The hoedown?
It's one of those. It's a wine tasting thing that someone invited me to, and there may be extra space. So I don't know if you guys are into that sort of thing.
Yeah. Is it in Napa?
It's actually in Healdsburg, and we're gonna be doing a limo. It's be one of those fun type of things. I gotta let this thing run for 8 more minutes.
Healdsburg.
Healdsburg, yes.
Yeah, I gotta go back to Nevada.
Oh, really?
Got the got my gym.
Oh.
So I told my guy that probably wouldn't be in. So when it runs for 8 more minutes, it just runs, right?
Well, yeah. I mean, technically, I should be kind of doing something. Maybe I could do a little dance. Yeah, that'll be nice when the other gym opens, because then, you have your regular gym, but would you work out during the day?
Yeah, I will. So when we sign up, I'll do one for me.
Yeah.
And then that way, just if the guys, how many guys have one, maybe we'll just go over,
That's what I'm thinking, like in the afternoon or something.
Yeah, just go for lunch. Go for lunch, and then come back and eat a salad or something. It'd be great to get into something. I kind of need to. I've been working out with my trainer for 4 years now, twice a week, and I have been completely incapable of committing to any additional exercise. Even though I keep talking, we bought the bike, and I haven't been on the bike since we moved into the house, and Peloton, and it's just
it's hard.
Yeah, that's
a lot of.
I have to force myself
Yes.
in certain ways, and having this commitment with Tim, has
Mhm.
forced me to show up, because if I don't show up, I get charged. So it's
That's a good way
I
to
wanna
get
flush
yourself
it.
motivated.
Yeah, it is, and plus it's a habit now, and
Yeah.
it's all about creating habits, because I don't have the discipline to exercise more. But if I have the habit of going twice a week, Monday night and Thursday nights.
Well, can you like ride the bike at home while you watch TV?
Oh,
all
I
night?
can totally. Yeah, yes. It's set up to where I could do that. I just haven't done. In fact, I should probably Thursday night. There's actually a really good game. I didn't set up TiVo. Hey, come on in, man.
We are recording, so don't swear.
Did
I
you
have
do
to
your,
let this thing run for 6 minutes.
Well, let's step outside and swear.
Yeah. Funny man. All right. That. Come on. Yeah. Frames drop, may not be enough resources to run. Don't know why. Okay. Frames being dropped may not have resources to run Logitech. Not sure what that means, but we're still running for about 5 more minutes here. And USB okay. Gotta do another one here. All right, so we got this here. Got this, oops, there. Got that there. And I've got this here. 2019 and October 12, 2019. And there. Let's do. Which one are we doing here? We're doing let's see here. See if we do that. What's going on here? You were watching The Best of Investing with Edward Brown and Mark Hanf.
All righty. See ya.
All right, buddy. See you later. Okay. Okay, that's better. This, got that, and that. And let's see if that goes through. All right, 2 more minutes, and then we have to go. So sometimes we record The Best of Investing, and sometimes we record Sports Econ 101, both produced by me, Edward Brown. Sports Econ 101 is a national sports show with me, and then I'm also joined by Vern Glenn, KPIX TV, San Francisco sports anchor, who's phenomenal, as you all know, and Bruce McGowan of KCBS in San Francisco. So we always have a lot of fun. And then The Best of Investing is the business show that we record for CMCM, and it airs every Saturday on the radio, KDOW, and on the dial. You turn the dial if you still have dials on your radio. 12:20 a.m. Or AM 12:20, I guess it is. And it's called The Best of Investing, and we talk about real estate and a whole bunch of other business stuff, as you noticed today. And I'm going to let this thing run for about a minute and hopefully not drag on too long. Because, see, the thing is, CMCM wants me to do a minute wants me to do 56 minutes. So that's what I got to do there. So in the meantime, I'm going to close up shop here, and we record generally on Thursdays, and hopefully there's not too much going on between Thursday and Saturday, because we're, sometimes we would miss stuff. So that's what we're doing there, and I'm sure you're all not interested in what's going on right now for this next like 45 seconds. But I still have to keep it running. So that's what I'm going to do. And after 45 seconds, I am going to turn it off, and then we will go from there. And it was another good show that we had. And we're going to go to 10, 9, 8, 7, 6, 5, 4, 3, 2, 1.